Welcome, everyone. My name is Dan Valenti, and I'm a portfolio manager with SMK Capital Management. And today I'm joined by our co-founder, Mark Khuri. We'll start by sharing some information on our firm and our experience, and then dive into the details of our third alternative income fund. Before we start, a brief disclaimer. All investments involve risk. You should consult your attorney, financial advisor, and/or accountant to understand the risks of this investment prior to considering an investment. None of the information contained here constitutes any offer to sell, nor is any information herein the solicitation or an offer to buy any security. Securities may only be purchased through offering documents which contain details about the risks associated with an investment in the fund. And with that out of the way, I'm going to kick it to Mark to give some background on the firm.
Thanks, Dan. I'll start out by just saying, we believe that who you invest with is just as important, if not maybe more important than what you invest in. So who are we? Our firm, SMK Capital Management, is a family-owned private equity real estate investment company. We've been providing investors with passive income and growth investments since 2010. We've created and managed over 65 partnerships with our investors over the years. And a brief background on us. My father, Dr. Khuri, is a retired orthopedic surgeon. He began investing in real estate in the 1970s. I got my start in 2005 while working in corporate America. I was in corporate finance and a financial analyst for a number of years. Also worked in operations management. Those two skills and experiences really meshed well for real estate investing. And so we started as a family pooling our capital together kind of through the recession a little bit before, really focusing on acquiring distressed value-add investments, a lot of REOs, short sales, foreclosures, boarded up houses while working. And then in 2010, I left corporate America, created our company, and we're off to the races. And so through that time period from 2010 to 2017, our focus was as an operating partner. We would acquire and renovate and operate a portfolio of a little over 60 properties in multiple states with our investors. At the same time, myself and a few of my family members were looking for diversification. We wanted to spread some of our personal capital out. We started investing as limited partners in other operating partners deals. We made over 20 investments in different asset classes, different operating partners, different areas of the country. And by the end of that time period, by around 2016, we had a pretty strong data set that we could compare and contrast risk, return, different strategies, different operating partners. And we really saw a compelling path forward to provide more diversification to our investors. They were looking for that. And so in 2017, we made a pivot to focus strictly on private equity real estate investment, started syndicating investments with our investors, partnering with operating partners that we had done well with personally for the last few years. And then by 2018, really narrowed the focus down to recession resistance. These are investments we'll talk a little bit more about when we go through our fund, but essentially just lowly correlated to the overall market where we think we can do well in varying market cycles. Now, today we're screening anywhere from 10 to 20 investments a month. We invest in about 4 to 8 a year. So around 97% or so of the deals that we see, we don't invest in for varying reasons. A lot of times, just nothing special, right? We see a lot of deals. We're always trying to find something that we think is quite unique that can allow us to reduce risk and still get a really attractive return. So with that, this is a bit of our experience here where we summarize our syndicated real estate investments. These are deals that we've invested with in other operating partners that have gone full cycle. You'll see that our average internal rate of return, through these investments has been 23%. All right, why don't we go ahead and shift now? I'll have Dan start talking a bit more about our Alternative Income Fund 3.
Thanks, Mark. Yeah, so over the past few years, we've offered 2 other alternative income funds focused strictly on mobile home parks and self-storage. With the success of those 2 funds, we opened our third fund earlier this year with the goal in mind to expand on our previous funds. So We basically aim to build a more diversified portfolio of cash flowing recession resistant assets and to provide our investors with immediate diversification. We've been successful in that endeavor as our investors become part owners in all of the investments within the fund. One of the main objectives of Fund 3 is to reduce risk through prudent alternative investment selection and by spreading capital across multiple assets, regions, and as well as operating partners. So over the past 10 months, we have analyzed hundreds of investment offerings, and our fund has selected and invested in only those that we found compelling. We'll dive into more details on those in a minute, but thus far, Fund 3 has invested it in self-storage facilities, mobile home parks, industrial, ATMs, and apartments, and private real estate debt. So again, the objective of Fund 3 is to build a diversified portfolio with an attractive blend of fixed income and growth. From the onset of our fund, we've maintained a very strategic allocation between both fixed income assets as well as income and growth assets. The fund is currently comprised of 7 separate investments with 27% of the portfolio allocated into fixed income and 73% of the portfolio allocated to income and growth. Income and growth investments span 24 properties, while fixed income is comprised of 1,800 ATMs and 52 private real estate loans. What this allocation allows is for us to earn strong cash flow, beating inflation, while also providing potential upside growth. So let's first review the fixed income generating investments that our fund has invested in. We'll start with the private debt fund. For this investment, we are the bank. Our capital is being lent in a first lien position, so it carries less risk than an equity investment, but also it does not have upside. Our capital is part of a large portfolio, which currently includes 52 individual loans totaling over $1.9 billion. And the capital is primarily lent to new construction borrowers who build large multifamily properties across the country, like the one you see here. Loan sizes range from $5 to $100 million, and the loans are short-term, less than 36 months. Once the property is built, borrowers will refinance or sell and pay off the loan. In terms of track record, our operating partners have a stellar track record with 200 paid off loans totaling over $4 billion with 0 losses. Pretty incredible. And this fund has been providing investors with consistent returns of over 10% paid quarterly since 2015. The second fixed income investment is into an ATM fund with an operating partner we've had great success with for over 4 years now. ATMs provide consistent cash flow of 25% per year, but there's no growth since we're investing in equipment that depreciates. However, the investment does offer the additional benefit of bonus depreciation, which allows us to take a large passive loss in year 1. In summary, these fixed income investments make up 27% of our fund, and they provide us with consistent annual income and stable returns.
Thanks, Dan. Appreciate you summarizing the fixed income investments in the fund thus far. I'm going to dive in now, guys, and we'll talk about each of the investments the fund has made into the more income and growth assets. These are investments that provide current income, but also have nice upside potential as well. Again, these make up 73% of the portfolio today. Now let's start with the first one. This is a triple net industrial sale leaseback portfolio that our fund is invested into. It's a mouthful for those of you not familiar with this niche. The sale leaseback process basically involves a company, typically a manufacturing business, that is owning and operating an industrial space, and they're selling the real estate that they are using and occupying it, and then they're leasing it back as the tenant. So that allows us to have 100% occupancy at acquisition, provides us with nice low risk day one. Another benefit of this investment, it's a great hedge against inflation and stagflation. And we refer to stagflation, we're seeing more of that in this current market, where we have flat or very minimally growing revenue, but rising expenses largely due to inflation. And so we like to combat that, and this investment very much does so. Since it's absolute triple net, the tenants are responsible for all expenses. That includes property taxes, insurance, utilities, and building maintenance. And most of the leases in this fund that we've invested into are 20-year long-term leases. They have built-in rent escalations between 2 and 4%. So it allows us to see net operating income grow even during a volatile market that we're currently in. Now, the portfolio that we've invested in here, it already includes 12 properties, so pretty well diversified even within this niche. And that's across 8 states, and we do project it to grow before it's closed. Regarding debt on these assets, we have about 70% loan to value. We have an interest rate of 3.9 to 6.5%. Those are fixed interest rates. And then we see a going in cap rate here of 7.5 to 8.1%. So one of the things we'll talk a bit more about through these investments that we selected, we really like to see that positive spread between the going in cap rate and the borrowing rate. And it's definitely a big part of our investment criteria today. The performance thus far, this fund has been providing investors with cash flow of 7 to 9% throughout the course of 2023. And we're projected to earn a 15 to 17% IRR and a 2x equity multiple, so doubling our capital through the investment term. Let's keep going. The next investment our fund here has made, this is into a mobile home park and self-storage portfolio. This is with a repeat operating partner that we continue to have great success with. We love mobile home parks and self-storage. We've been investing in them for over 10 years. We find them to be quite recession resistant, lowly correlated to the economy. You often see demand increasing during economic downturns. And this portfolio that we've invested in has already acquired and owned 7 self-storage properties in 6 states with over 2,000 units. So some nice diversification across storage. Our operating partners here are in due diligence as we speak on 2 additional mobile home park investments and a self-storage portfolio that could be added to the fund if they pass their due diligence, of course. So one thing that makes our operating partners unique here, they have a team of 6 full-time acquisitions team. All they do all day long is cold call mobile home park and self-storage owners. They're looking for mom and pop owners. They've been doing that for over 10 years, and it provides them with some pretty amazing deal flow. We can talk a lot more about that if you guys have questions, but a lot of what they're looking for is some type of human error where the owners of the properties have been mismanaging or maybe managing to occupancy, and they don't even know that their rents are 40% below market, or potentially the opposite. They're not managing at all. We've seen that numerous times, predominantly in storage as well, where there's no advertising, there's no marketing, and most people who are looking for storage go online and do a Google search when trying to figure out if they're going to rent some storage space. So a lot of low-hanging fruit is really where they focus. And the project level projections for the assets in this portfolio thus far start out at 4% cash flow in year 1, 20 to 25% IRR, and a 2 to 3x equity multiple. Next investment that our fund has made is into a mobile home park portfolio. Now, this portfolio was recently acquired. It's 4 communities, 91% occupied, 233 lots. The photos at the bottom, I took most of those. They're all part of this portfolio. This is in the Kansas City metro. And the going in cap rates, again, a trend you'll see with a lot of our investments here, ranging between 7.4 to 11.1%, while we have 5-year fixed rate debt at 6.95%. So a pretty healthy spread at the onset of this investment. One thing that's also unique here, this portfolio was in escrow in October of 2022 for 35% higher purchase price. Our operating partners have been tracking it and following it, and they finally got it over the line. So we're really excited about the basis here. Our fund is projected to earn 3% cash flow in year 1. That's projected to grow to 9% in year 2, and overall 15 to 16% IRR, and a 2.7x equity multiple. Okay, we've made a couple apartment investments too. We're very selective with apartments these days. We do love tax-exempt apartments. This is an investment we made just in Q3. This is in Houston, Texas, about 10 minutes from NASA. These are two properties right next door to one another, 532 units. They were built in 2008, 94 and 96% occupied. Now, they're the only two properties within 3 miles that have not been renovated. So there's a nice value add play here to inject capital, renovate the units, and grow the rents. And one of the things that makes this investment unique, the tax exemption. 50% of the units at the property will be income and rent restricted. So we're essentially creating affordable housing. The remaining 50% will be at market rates. And in turn, we get 100% property tax abatement for 99 years. So starting day one, we do not have to pay property taxes. And in Texas, on these assets of this size, that saves us over $1 million just starting in year one in real estate property taxes. And you can see some of the value that this creates. The purchase price on these two assets was a little over 80 million, whereas the appraised values came in at over 113 million. So this tax exemption really creates a lot of inherent value on day one of ownership. Again, you see a nice healthy spread here about between the going-in cap rate and the 10-year fixed interest rate of 5.36%. We have about 150 basis points spread. And our projections here, that our fund will earn 7% cash flow in year one, 15 to 17% IRR, and a 2.5x equity multiple. Okay, the last investment our fund has made thus far, this is into a value add apartment community, San Bernardino, California. It's 162 units, 92% average occupancy throughout 2023, built in 1985. And what makes this unique? Our operating partners own the asset right next door, and they have a little bit of insider information into this submarket. The asset next door has had very high demand for garages, and they've been renting them out at $150 a month per garage. And there's a waiting list for them. And the property that we're talking about here that we've invested in doesn't have any garages. So one of the value add measures here is to build 88 garages and rent them out for $150 a month. The additional income that's generated by these alone is projected to increase the property value by over $3 million. That's based on about a 5.25 cap rate. Another unique attribute here, our operating partners have signed personal guarantees on the debt. They've also personally guaranteed the full return of our capital that's been invested. So a really attractive risk protection measure here. Lastly, our fund is projected to earn 8% cash flow in year one, 22% average annual return, and a 1.44 equity multiple over a 2-year hold. Okay, I'm going to shift gears, let Dan talk about the fund's projected returns.
Thanks, Mark. Yeah, so for the fund, we're offering 3 class shares with minimums of 500, 250, and 50K for Class A, B, and C, respectively. The fund's structured with a simple cash flow and profit split, so investors will earn 80 to 90% of the net income that comes into the fund from operations and property sales, and there's no limit on upside. SMK earns the difference of the 10 to 20% depending on share class. The structure is really incentivizes us to ensure we select cash flowing and highly profitable investments. And so the result is a projected equity multiple of 1.55 to 1.7x and an average annual ROI of 11 to 16%, depending on share class.
Thanks, Dan. As you can see on the right, guys, we have a annual asset management fee of 1%. That's on equity invested. We also have a one-time acquisition disposition fee of the same. The investment term is 5 years. We project to begin returning capital sooner than that, through years 2 through 4. And we do investor distributions and updates quarterly. And you can see the projected annual cash flows. These are all net to investors on the right here, starting in year 1 from 4 to 7, and then increasing from there. I will mention one thing. We created these projections the onset of our fund where we had only identified a few of the investments. And so when we go back and reforecast today after the investments that we've shared with you that are in the fund, we do find these projections to be a bit conservative. Now with that, happy to share my contact information, guys. It's on the screen here. Also, if you're interested to make an investment or you want to learn more about it, you can create an account on our website, smkcap.com. We have a sign up button, and there's a lot of information there that you guys can